Hey friends, welcome back to the channel. I'm Iggy, and I've been covering topics like stocks, finance, CPF, and everything related to growing your wealth right here in Singapore. Today, we're putting a specific SGX-listed company under the microscope for a deep dive analysis. The investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers. We just crossed the 1 million mark for number of reads and 58,000 likes. I've produced over 900 videos with more than 500,000 watch hours as of June 2025. I also focus on regional and global economic trends. If you're serious about uncovering the hidden gems and potential pitfalls in the Singapore market, you'll want to hear this. Today we're dissecting Frasers Centrepoint Trust, ticker J69U. And I need to address a massive misconception that's floating around. Many investors think FCT is just another boring suburban mall REIT that's stuck in the past, destined to be crushed by e-commerce. But here's what they're missing. FCT has quietly built an unbreakable suburban retail empire worth over $8 billion, and their recent results tell a completely different story. The question isn't whether FCT will survive the retail apocalypse, but whether you're smart enough to recognize a defensive cash cow when you see one. We're going to break this down systematically. First, I'll show you 3 compelling reasons why FCT deserves serious consideration in your portfolio. Then, we'll examine 3 red flags that could derail your investment thesis. Finally, I'll give you my personal rating and strategic advice on how Singaporean investors should approach this stock. Let's dive in. The first major strength is FCT's absolute dominance in Singapore's suburban retail market. This isn't just market leadership, it's market control. FCT commands over 10% of Singapore's suburban retail space, owning 9 strategically positioned malls from Causeway Point in the north to Tampines 1 in the east. When you control the best suburban retail real estate where Singaporeans conduct their daily shopping, you create something economists call a natural monopoly. Tenants literally have nowhere else to go. The numbers prove this dominance translates into pricing power. FCT achieved an impressive 9% average rental reversion in the first half of 2025, up from 7.7% the previous year. Think about what this means. In an environment where many retailers are struggling, FCT is actually increasing rents by nearly 10%. That's not luck. That's market power. Their portfolio occupancy remained rock solid at 99.5%, meaning virtually every available space is generating income. This defensive positioning becomes even more valuable as e-commerce pressures traditional retail, because suburban malls serving daily necessities prove far more resilient than discretionary shopping destinations. The second compelling factor is FCT's proven ability to create value through asset enhancement initiatives. Management consistently demonstrates they can extract additional returns from existing properties without the risks of major acquisitions. The completed Tampines 1 enhancement exemplifies this approach, achieving returns exceeding 8% while adding over 9,000 square feet of rentable space. The current Hougang Mall project, with a $51 million budget, already shows 64% pre-leasing before construction completion. This isn't speculative development. It's calculated value creation based on genuine tenant demand. These enhancements create a compounding effect that many investors underestimate. Enhanced spaces command premium rents, while improved tenant mix drives higher foot traffic and sales. FCT's shopper traffic grew 1% year-on-year in the first half of 2025, with tenant sales rising 3.3%. In a challenging retail environment, these are impressive metrics that demonstrate the underlying strength of their suburban positioning. The third strength is FCT's attractive yield combined with distribution growth potential. The current dividend yield of 5.4% appears compelling, especially when you consider the quality of the underlying cash flows. The first half 2025 distribution per unit of 6.054 cents represents steady growth supported by operational improvements rather than unsustainable leverage. FCT's financial position supports this confident distribution policy with aggregate leverage at a conservative 39.3%, providing substantial headroom below the 50% regulatory cap. What makes this yield particularly attractive is the quality of earnings. FCT's suburban malls generate predictable cash flows from essential spending categories that prove resilient during economic downturns. This defensive cash flow profile, combined with their market-leading position, supports reliable distribution forecasting. With interest rates potentially declining from current levels, FCT positions to benefit significantly, unlike REITs, heavily hedged at fixed rates. Now let's examine the 3 red flags that smart investors cannot ignore. The first major concern is valuation metrics that flash warning signals. FCT trades at 1.1 times price-to-book value, a premium that demands scrutiny given current market conditions. More concerning, the price-to-earnings ratio of 22.1 times significantly exceeds the industry average of 15.2 times. This means investors are paying a substantial premium for FCT's suburban retail exposure. The dividend sustainability question adds another layer of concern. At current distribution levels, FCT must maintain high occupancy and rental growth to justify its yield. Any softening in suburban retail demand or unexpected increase in operating costs could pressure distribution capacity. The current yield of 5.4% must be evaluated against Singapore's 10-year government bond yield around 2.2%. Conservative investors might find government securities offering 2 to 3% yields with zero credit risk more attractive on a risk-adjusted basis. The second red flag is interest rate sensitivity that creates ongoing vulnerability. FCT's capital structure continues to expose unit holders to interest rate risk despite recent improvements. While the average cost of debt decreased to 4% as of March 2025, any resumption of hawkish monetary policy could quickly erode distribution capacity. The interest coverage ratio at 3.33 times provides limited comfort for current operations, but offers little buffer should rental income face pressure or debt costs surge unexpectedly. Singapore's monetary policy stance, while currently accommodative, remains data-dependent. With core inflation showing signs of stabilization, the Monetary Authority of Singapore may pause further easing if inflationary pressures resurface, potentially keeping interest rates elevated longer than expected. This creates an environment where FCT's distribution capacity remains vulnerable to external monetary policy decisions beyond management's control. The third concern involves sector headwinds and limited growth catalysts that constrain FCT's long-term potential. Singapore's retail sector faces structural challenges that FCT cannot escape, despite its suburban focus. The rise of e-commerce continues pressuring physical retail, with online penetration likely to increase further as digital natives become primary consumers. FCT's growth options appear increasingly constrained with suburban retail space in Singapore limited and competition intense for quality assets. The demographic trends in suburban Singapore present mixed signals. While population density supports current operations, changing shopping patterns among younger consumers favor online and experiential retail over traditional mall formats. FCT's tenant mix, while defensive, may struggle to attract digital native consumers over time. Tourism recovery patterns continue to favor experiences over retail spending, potentially reducing tourist spending at suburban malls near transportation hubs. For even more granular data, in-depth charts, and a full written breakdown of Frasers Centrepoint Trust's financials, make sure to check out our Substack. The link is right there in the description. Now for my personal analysis and rating. After weighing all factors, FCT represents a classic defensive quality investment with premium pricing. The suburban retail dominance creates genuine competitive advantages that translate into consistent cash flows and distribution capacity. Management's track record of value creation through asset enhancements demonstrates operational excellence that justifies some valuation premium. However, the current price of $2.27 offers limited margin of safety given the structural challenges facing retail real estate. The 22 times price-to-earnings ratio suggests investors are paying for perfection in a sector that faces ongoing headwinds from e-commerce and changing consumer behavior. My personal rating for FCT is hold with a bias toward income-focused investors. This isn't a growth story. It's a defensive income play that requires careful position sizing. For conservative income investors seeking steady dividends with inflation protection, FCT merits consideration as a modest portfolio allocation of 2 to 3%. The 5.4% yield provides competitive income, while the defensive nature of suburban retail offers portfolio stability. For growth-oriented investors, FCT's limited expansion prospects and mature market position offer minimal upside catalysts beyond asset enhancement programs. The premium valuation reduces capital appreciation potential compared to other REIT sectors with stronger growth prospects. For CPF and SRS investors, FCT's steady distribution profile suits retirement planning, though diversification across sectors remains crucial. My strategic advice is to monitor FCT's interest coverage ratio quarterly and track suburban retail evolution closely. The upcoming Hougang Mall enhancement completion will test management's value creation capabilities. Consider FCT as a defensive holding rather than a growth investment, and size positions accordingly based on your income requirements and risk tolerance. So we've broken down Frasers Centrepoint Trust piece by piece, looking at its strengths and weaknesses, and I've given you my personal verdict and strategy advice. If you found this level of in-depth, actionable analysis truly valuable, please give this video a like. Share it with fellow investors, and subscribe to the Investing Iguana channel so you don't miss our future deep dives. And for those who want to be truly ahead, our premium members gain exclusive early access to all our videos, often a full week before anyone else sees them. This means you get Iggy's detailed analyses and urgent insights on major market moves directly to your inbox, giving you a significant head start. It's just $1 a month, less than a cup of coffee. Think of it as your consistent daily dose of financial fuel for smarter decisions, delivered before the masses. Ready to join the inner circle and get that early edge? Just click the link in the description below to become a premium member today.